All right, good afternoon. It is 12 o'clock Eastern here at Aquinas at 1127 Dewey Avenue. I know people are, I can see, logging on now, but we try to be punctual for everything we do at Aquinas, whether you are going to class or going to a webinar. So this afternoon's webinar is going to be presented by Ryan Bierley, class of 98 of Bierley Financial Services, and Todd McGee from Mass Mutual, who I just found out is going to be presenting from Springfield, Massachusetts. Ryan is here in Rochester. And for a couple of housekeeping points, one is, and I'll say this again at the end, this was being recorded and will be on demand afterwards and will be on our YouTube channel, AQ 1902. For viewing in the future, along with our previous alumni webinars that we've held. So if you missed something or you forgot something, you can go back and watch it. Obviously, I think Ryan and Terry will be sharing their contact information later. You can always call our office as well. Or if you talk to somebody else, let them know that they missed it, but they can watch it on AQ 1902, the Aquinas Institute YouTube channel. So at this point, I'd like to introduce Ryan Bierley, and it does say Terry, and we're not sure why, but it is Todd McGee. I'm going to be monitoring the chat room and the Q&As. So if you have questions during their presentation, feel free to put them up there. We'll most likely address all of them at the end because there'll be time for Q&A. So feel free to not wait to put it in the chat room because we'll be able to filter them out at the beginning. So I'd like to welcome Ryan and Terry to the webinar. I know they're out there.
Good afternoon.
Welcome, gentlemen. I'm going to let Ryan, I'm going to let you start. I know you're going to start us off with the prayers. We do all things.
Yeah. In the name of the Father, the Son, Holy Spirit. Amen. Lord, thank you for this opportunity to serve. We pray that this discussion leads to many more discussions to help people in the community with their plan giving efforts. Thank you for the time we're spending today, the knowledge that we're sharing, and we pray it leads to helping Aquinas and others with their plan giving efforts. In Christ's name we pray, amen.
All right, I'm gonna let Ryan and Todd introduce themselves, and then they're gonna have to present, and then we'll get back with Q&As.
Thank you everyone for your time today. Again, my name is Ryan Bierley. I graduated from Aquinas in 1998. I've been a financial advisor for the past 12 years. I live in the Rochester community with my wife, Amy, and my daughter, Ava. And today we'll be talking specifically about plan giving using life insurance. There's many different areas of plan giving, and it can be confusing. The tax laws change constantly. The rules and regulations around giving is constantly changing. And I'm very fortunate and honored to have Todd McGee with us today. And Todd is an expert in this area of plan giving, specifically with life insurance. Todd spent the last 17 years with Mass Mutual, the head of advanced planning, which deals with businesses and plan giving. And so Todd has a nice presentation for us this afternoon. We're going to go through that, and then we have a question and answer session at the end. And I'll also share my contact information should you have some more questions you want to ask more specifically about down the road. Todd, go ahead, and thank you for your time today.
Well, thank you very much. Let me just upload everything here. We should be able to see the PowerPoint. I just bring this up. So good afternoon to everyone, and thank you for having me here. I know my time is limited, so I put it in a PowerPoint so that way if you're going back, you want to look at it, you can at least look at the slides and kind of see what's going on. As Ryan said, unfortunately nowadays we have a rule, those rules start changing quickly, and depending on what happens next year with new tax laws, everything I tell you today might not be correct because they changed it again. So we'll tell you the rules as we know them today, only understand that they are subject to change. With that, anytime I'm out here, please know that I am an attorney. I was in a private practice before coming in-house, but I worked for Mass Mutual. And therefore, if you're looking for tax or legal advice, we have to encourage you that you seek advice from your own legal counsel, simply to confirm what I told you today was correct. But if you're looking for certain planning aspects, you do have to seek your own legal counsel. So I've done my compliance pitch. Here, kind of the thing we always start off with is what really is a deduction for charitable purposes. And the reason I bring this up is because of the changes over the last few years, just like the last 2-3 years, the numbers have changed. It's caused confusion in the industry. It used to be that if I made a cash contribution to a charity, a qualified charity, then 50% of my adjusted gross income would be my deduction limitation. Well, the 2017 Tax Act changed that to 60%. So they bumped it up by 10%. To make it more confusing, well, they turn around and they say, hey, look, you got a 60% deduction for cash contributions to a public charity. However, if you're given certain type of assets, you might fall to the 50, 30, 20% standard. So you have all these different benchmarks as to what is my deduction limitation. Well, if I'm giving to a public charity, cash that is, it's 60%. So I kind of broke it down for you here. Public charity, if it's non-cash, ordinary income property, or short-term capital gains, it's 50%. If it's capital gains type property, then it's going to be the fair market value subject to the 30% standard. If I'm giving to a private foundation, then you can see it's the 30% limitation, unless I get to that capital gains property again, it's going to be 20%. To make it even more confusing, and it's missing from this, the CARES Act over the last 2 years bumped that 60% up over the last 2 years, last year and this year, to 100%. So 100% of cash contributions up to your AGI would be my deductible limitation. That ends after this year and then goes back to the old rule of 60%. So if you hear 50, 60, 100, 30, 20, where do I fall? Stop, take a look at the slide, and you'll see if it's cash, 100% this year, and then next year it'll go back to 60, and then 50, 30, 20 standard, as you can see here on the slide. Really what we're here for, now that you kind of know the benchmarks as to your percentages, is really how does life insurance fit in? And this is where it gets really confusing, because some people believe, if I read it on, online, it was true, but there are certain ways of giving life insurance and whether or not it's going to allow you to have a deduction, or I might not want a deduction. I just want to make sure I take care of my charity of choice. So here, you have 3 options, I like to say. You can name a charity as a beneficiary. You can donate an existing life insurance policy to a charity, or you can have a new policy issued to the charity and then have cash contributions to help pay the premium. We'll go in through each. So here, I own a life insurance policy on me. And I name, Ryan as my son, 50% beneficiary, 60%, 70%. I can pick whatever I want. It's my choice. I can name him 100% beneficiary of my life policy. But here I want to do some charitable planning. I don't want to give the whole thing to the charity. So what I'll do is I'll say, hey, I'm going to give, I have a $200,000 death benefit on the life insurance policy that I own on myself. I'm the owner. I'm the insured. I'm going to name Ryan as 50%. He's going to get $100,000 if I pass away. That's going to go to him tax-free. Well, I name the other 50% the charity of my choice. So now upon my passing, $100,000 goes to Ryan, $100,000 goes to the named charity. The benefit there is, well, I'm leaving a larger pool of money to the charity. It allows me flexibility in what I want to do. As I get older, Ryan, got a new job. He's got a new career. His family's growing. He's doing well for himself. Maybe he doesn't need the 50%. I can change my beneficiary designation at any point in time and give him 30%. I could give him a stated value. I want him to get 50,000 of the 200. In my example, the rest will go to the charity. So it gives me that flexibility to change it however I want, whenever I want, up into my death. So I could offer it up as a straight out beneficiary, a split beneficiary. I could name the charity as a contingent beneficiary. If Ryan is not here, then I want the charity to step into his place and then get the whole sum. A lot of flexibility on how I want to do it. But the real, and they always have to give a picture. Compliance always wants you to have a picture in case you didn't know. But here, the real issue is the taxes associated with it. The death benefit, since I own that policy up into my date of death, is in my estate for estate tax purposes. Now, right now, people should know that your exemption today, if I were to pass away as a single person, I have an exemption of 11,700,000. If my estate doesn't exceed that, then I don't have a federal estate tax problem because I didn't go over the exemption amount. Well, if I do exceed that, I'm worth $11 million, of which I have a life insurance policy for $2 million. Well, life insurance, I own it to my date of death. That 2 million plus the 11 puts me at 13. I've exceeded the 11.7. I will have an estate tax on the difference at 40%. I bring that up because next year, if they change the rules, and I'm not going to tell you if they are or if they're not, that's all subject for debate. But let's say it were to go down to what the current model is, which is saying in 2026, it'll go down to the 5 million plus indexing. So your exemption per person will be about $6 million. So let's say that does happen and they put that in place next year. Let's say that it may happen. I'm not saying it did, but as an example, let's say it did. Well, I went from 11.7 down to 6. I may have not had an estate tax problem currently, but if the exemption were to go down, maybe I do. And if I own that life insurance policy, it's in my estate for the calculation. So that's an issue always to watch out for. But the other thing is, well, since I had the ability to change that beneficiary designation at any point in time, then I don't get a deduction. And that really does make sense because if I put down the charity today with Ryan, 50-50, we're each going to get $100,000. Well, 4 days from now, I say, you know what? I really don't want to give it to that school or that charity. I'm going to change it again. And I put Ryan as 100%. And then I die. Well, the charity never got anything. So why should I get a deduction? Because I didn't receive it. So the benefit here is I get the control and the flexibility as to how I want to change it over time, but I don't get the deduction up front. Now, when I pass away, as the death benefit goes to the charity, although it might have been added to my estate for the estate tax calculation, it will offset what goes to the charity to help offset my estate tax. So you got to see it in two different frames. So once again, it provides flexibility. The death benefit goes to the charity of your choice, however you want it, percentage, straight out number, what have you. Disadvantage, no deduction. Well, the other one is the option number 2 is I have existing policies. Some people have multiple policies. I may have taken some, put it into a trust for my kids. I may have a couple policies that are paid up and I'm not sure what to do with them. Maybe I take one of those policies and I transfer it to the charity. So I change ownership from me to the charity. Charity is now owner and beneficiary. So I'd have to do that owner beneficiary designation to get it over to the charity. It's a simple form that you fill out, or I would fill out because I'm the one donating it, and then it goes to the charity. Now the benefit there is the charity owns the policy. They control it, of which maybe it wasn't a paid up policy. In the following years, as I give money to pay for that premium, those are my contributions to then be applied as a deduction to offset my income. So right now, I just threw a couple of things at you: state tax issues, gifting issues, and income issues. A lot of different tax ramifications depending on how we do it. Here, if I give it, it's a gift, of which, since it's going to a charity, I have to see if it's going to be a gift that qualifies for the 100, 60, 50% benchmark. Here, let's just say it's 60%. We're back in that next year. Well, that's my deduction offset for my gift based on its fair market value. So if I give a policy to a charity, it's the premiums paid. It's the first bullet point. Premiums paid would be my deduction, which is, as the IRS calls it, the lesser of the fair market value or the cost basis. So you're going to ask, I would ask, because it's my policy, what is the fair market value of that policy? I need the fair market value and its cost basis at the time of me transferring that policy. And that's what my deduction limitation will be based on. The IRS says it's the lesser of the two. So if I have a cost basis of 100,000, but the fair market value is only 90, I got to go with the 90. So you got to remember that. It's not, once again, it's not your issue. That's your CPA and everyone, but just understand there is that nuance to it when you're giving up a policy. The benefit here, though, is now the charity owns the policy. If it wasn't a paid up type contract, the following year I give cash to the charity. Forget the first transaction, which was getting the policy over there. It's now me making a cash contribution. If I'm into next year, it's 60% of my adjusted gross income. That is what my deduction is based off of for income tax purposes. Advantages, it helps provide a legacy for you with that charity. In essence, I'll make up an example. I was giving $10,000 a year to the charity. It's now going to the life policy. As the donor, I pass away. The death benefit coming in was $500,000. Well, now I just left a big pool of money to the charity for my legacy and for my family. It also provides liquidity for the charity to use however they want going forward. And it's simple. It's a simple arrangement. As anything that is simple, if anyone tells you, especially an attorney or CPA, it's always not that simple. One negative is I need a qualified appraiser to appraise that policy. So way back when they passed this rule saying that if I give a policy to a charity, whatever that fair market value is, I can't run to the life insurance carrier and say, hey, tell me what the value is. I'm going to have myself get that for me so I know the lesser of the two. But if it's anything over $5,000, I'm required by law to go to a qualified appraiser, which is not the insurance carrier. Go to that qualified appraiser and say, hey, here's my policy. Please appraise it. Give me that fair market value so I can file it in my tax returns to justify the deduction. So just understand there's that hurdle or that next step that you have to take when dealing with life policies as you transfer them to a charity. It's not hard, but it's a fee associated with it. The qualified appraiser is going to cost you, and you need that in order to file it with your tax returns. Anything over $5,000 of value. Well, the last option or the third option is really a new policy. I don't have any existing policies. Whatever policies that I do have that may be existing, I don't want to give them up. I'm going to use them for my kids or estate planning, whatever. I can get a new policy issued. So the first thing is, well, can a charity own a policy on me? I didn't transfer it in. If I transfer it in, I have a right to give it to whoever I want. Well, can I issue a new policy to a charity on my life? Yes, state law says you can have an insurable interest there. We have to look at the state statutes, but in all states, I don't know of any that says no. So you have an insurable interest there. I'm a member of the institution, I'm an alumni, then I'd have an insurable interest. Now, the insurance carrier may have a limitation as to how much they'll allow for you to have a life policy in that charity. I'm a first-time donor. I'm probably not going to be able to get a large death benefit. It might start me off small until I work my way up. Just understand that caveat. But the charity would go out and apply for a policy on me. I'm the alumnus, or I'm a provider, whatever it is, I'm the charitable person. Well, charity applies for a policy. I consent to it. So now the charity is owner and beneficiary when it's issued to the charity from day one. I didn't transfer it in, so I don't have to get that appraised or anything. It is issued to the carrier or to the charity right away. Anytime I make a premium payment, that's cash. So now I'm back to that 160, 50% standard that I talked about way back when. So now I'm just giving cash to help pay for the premium. Once again, here's your pictures that say everything that I just told you is correct. So you got the donor, contract, and the premium payments. The tax ramification is, well, since I'm making cash contributions, it's deductible for me. The charity can use the contributions to pay the premium. And now that's where the product comes in. That's where Ryan comes in to be very helpful here. He's going to tell you, hey, look, I could get a term policy, a UL, I could get a variable policy, I could get a whole life policy. All different types of way products are designed out in the industry. I'm just going to talk about a whole life policy because they mention cash value here. If I have a whole life policy, I have a cash value growing inside that policy. Why is that beneficial? A term policy compared to a whole life doesn't have that option. So term policy, if I die, the death benefit goes to the charity. That's great. That's there for them, but they have to wait till I die. If I have a whole life policy, it's growing inside the company as a sinking fund. Yeah, it's going to be nice when I pass away and the death benefit goes to the charity to provide for legacy and give them money that they need to keep the charity going. The real issue is they have to wait. I might live to 107 or whatever it is. They got to wait a long time. Or if I have that sinking fund from a whole life policy, they can use it right now. They can use it as a sinking fund or whatever they want to help pay the electric bills, put on a new roof, whatever it is. It's their asset. And therefore, it provides them more flexibility until that death benefit comes in on the backside. So one final option, and then I'll turn it back over to Ryan, because I think I'm towards the end of my time. We hear this a lot, and it does cause a little confusion. What's this thing called wealth replacement trust? It sounds really fancy. All it really is, in essence, some people like to leave assets to a charity, real estate, buildings that provide rental property, whatever it is, stocks, whatever it is. So they're going to leave that to the charity. Well, what about my family? Well, it's wealth replacement. Here, what I might do and what people do look at is I'm going to set up a trust. I'm going to get life insurance in the trust for my family. So once again, the life insurance has nothing to do with the charity. It's the trust that I set up. They call them irrevocable life insurance trust, owns a policy on me. I pass away, the death benefit goes into the trust to provide for my children, my family, and take care of them, whoever my beneficiaries are. I then leave whatever assets I want to the charity. By doing that, I'm transferring wealth back and forth. The assets go to the charity. That's going to help offset my estate tax exposure, whereas the death benefit comes in tax-free to give to my family to kind of cover what I just gave away to the charity. Hence, wealth replacement. That's all it really is. It's a fancy term of art that kind of scares people. Just understand, I'm not giving the life insurance to the charity. I'm giving it to the family because I'm putting assets over to the charity. I'm kind of just doing the reverse. So with that, I'll stop there and I'll turn it back over to Ryan. If there are any questions, I'd be more than happy to answer any of them.
Great. Todd, thank you so much for your expertise and your time today. We appreciate it. And if anyone wants to learn more about the 3 different ways we can use life insurance with planned giving, I'd be happy to help you with that. As Todd mentioned, a lot of them are very simple but effective. Changing beneficiaries on existing contracts, getting contracts titled to be owned by the charity. I could certainly help navigate all those different decisions if you have them down the road. And we'll be sending you an email in the coming days just with a follow-up to see if you had questions and what you thought of the seminar today. And I would like to open up the floor to questions for Todd and myself.
So actually, I'll start off because I have a couple of quick questions. So one of the things I do for Aquinas is I work with people's estates and major gifts. So I live on the outside of this world. And even though I've been to training, maybe a higher level user than a lay person, it can be very confusing. What is your suggestion for people that say, you know what, it's too confusing, you know what, I'll figure it out later? I guess, should they be scared? Can it be very intimidating to start talking about, especially with taxes and laws and this requirements? What tips would you give to somebody who, again, maybe they have life insurance, maybe they didn't even have it yet, but to dive into this without being too intimidated?
Well, I'd say the first thing is, give Ryan a call, give you a call, because you have the experience with it, to just start the discussion. In essence, we're not telling you to do anything with your life policies. You have options when it comes to what you can and cannot do with your life insurance and how you want to move it around. There are a lot of nasty rules out there about when you move a policy, it could cause the death benefit to be taxable. When dealing with a charity, that's not going to happen here, but just understand, don't get scared by it. There are professionals like Ryan and you out there who can walk you through this and tell you what your options are. And then from there, you make that choice. Don't be scared by it. My famous thing is when I was in the private practice before coming in-house, people don't want to talk about death because, it is scary. Because of what happened in the not so recent past with the virus, we saw a large increase of people running back to their attorney to do their estate planning because that scared them. Estate planning shouldn't be a scary matter. I'll share this with you. My first day at Boston University in their master's tax program, the professor came in and said, there's 2 guarantees in life in this class. There's 2 guarantees. So I'm ready with my pencil to write down what those guarantees are. And he said, there's death, there's taxes. It's an absolute guarantee. Can't be afraid by it. If you know it's going to happen, you got to plan for it properly. The worst thing I've seen is where we're too afraid to answer the questions or just get the information and we do nothing. And the policy that I thought that I did correctly was going to go to my spouse and my kids to take care of them. And I didn't do the beneficiary designation correctly. And now it goes back to my estate, and maybe I had creditor issues or something. Now my policy, which was once avoiding the probate process, is thrown back in and now subject to issues. So just asking the question allows you to avoid some really nitpicky issues that you would avoid if you just did it correctly.
Great, that's actually good advice. I have one more question, but before I do, I want to open it up. So if you have a question, put it in the chat box, put it in the Q&A, and we'll pass it along. What about people who think insurance and big life insurance, or using life insurance for gifting, or any of this stuff with tax, talking to attorneys or accountants? That's for rich folks. That's for the wealthy. I'm a regular Joe. What do you say to someone that says something like that?
Well, I'd like to answer that one, Jake. A big part of what I do is just getting people to sit down and have a cup of coffee with me, right? The people that need a financial advisor, they need a tax attorney, they need good advice, life agent that's knowledgeable. They're the middle class and the working class, right? The millionaires can make mistakes. So there's a big misnomer out there that the average Joe doesn't need, a financial advisor, and it's intimidating. But the most good I do is for middle class people that need a financial advisor. And specifically with the life insurance, it is intimidating when you think about it. People think, what is it going to cost you and what can it do? But if people sit down and actually see the leverage that their money gets for what they want to do, the average person that may think, I can't leave a large gift to Aquinas. I don't have the resources. I'm going to take care of my spouse and my kids, and that's it. With the proper planning and not any more money coming out of their pocket, with life insurance, pennies are leveraged into dollars. So taking existing assets and taking a snapshot of where they are, people are generally surprised with the good that they can do with not that much money. And the guy or girl that thought, hey, I would love to have a scholarship in my name at Aquinas. I'd love to give a large gift, have a new science wing at Aquinas or a charity. They can't do it with what they have, but a lot of people would be surprised if, they had a properly structured life insurance plan, the impact they could make. They'd be able to take care of their families as they were anyhow, but also do something special maybe for their favorite charity. So I just encourage people to start the conversation, because it's an important thing to do. And a lot of people, they're hesitant to start, but once they sit down, have a 10 or 15-minute phone call, even they're happy with the results. Because if it's not for them, plan giving, well, then they know it's not for them. But at the very least, they got the information and were able to make a good assessment about it.
Before I get to a question that was asked here, and I think, Todd, you touched on this. So we have a couple of gifts here at Aquinas, and Ryan, you're kind of alluding to this, that there are people say, I want to leave something, but what I would like to do and what I can do are two different things. We've had a couple people who have done two things. They bought life insurance policies just to leave to Aquinas. And then there's another couple people who have allowed us to be the owners of the policy. And what that does, but there's two things. One is, and I'm throwing numbers out and you guys can correct me in terms of getting more on track, but I'll give you one very specific. We have one that we own that's $1 million policy. When this gentleman passes away and his spouse died, we're going to get $1 million. He paid for that over 7 years, paying the premiums. And then there was a balloon payment at the end. But I think the overall payment that he made to the insurance company was just over $200,000. I'm in the ballpark, maybe $225,000 in premiums. So when what he did is, since we own the policy, he gifted we pay the premiums. We own the policy. But what he did is he would gift us every year. All right, the premium is, I'm just making up a number, but I think for the balloon payment it was like $14,000 a year. He'd write us a check for $14,000, which is deductible on his taxes because it's a gift to the school. We turn around and take that money and pay the premiums. So he does a couple things. He can give $1 million gift that cost him 200,000, just over $200,000. Because that was, yeah, I can give you 200,000. I can't give you $1 million. Well, here's how you turn that 200,000
Yeah.
into $1 million, and that 200,000 he still gets the deduction on. So you know, it was a win-win. So I think yes, I always say it's an interesting tool to use that, but people have to think outside the box. It's an opportunity to make a larger gift than you could afford to.
Thank you for that, Jay. Another one that we've discussed, and a lot of Aquinas alums or people just giving generally use, is the required minimum distributions from their qualified plans. So a big one is, hey, I have a $500,000 IRA. The IRS makes me pull out 20,000. I pay the tax on it, and then I give Aquinas 15 grand. Well, and people think, well, I can't afford these premium payments, or I don't have the assets to do that type of giving and that type of planning. Sitting down with a financial advisor and just looking at a snapshot of your current assets, I've repositioned clients' required minimum distributions that they were literally just putting in the checking account or giving a small gift to their church or charity. And we've used those proceeds and purchased large face amount life insurance contracts in order to leverage that gift, that money that the IRS is making them take out. They're leveraging that to much larger gifts for their favorite organizations. So there's a lot to it, but a financial professional will definitely be able to walk you through all the different ins and outs and help you actually find maybe premium dollars that you haven't thought of to help fund your favorite charity organization's efforts.
Right. Question that came up was, Todd, you mentioned divvying up whether you use percentages or dollars. Is there a benefit or pro and con basing it on percentages versus dollars or dollars versus percentages?
It's a great question. It really is preference as to what you want to do. I mean, I could say in my example, 50% was going to go to Ryan as my son, and 50% was going to go to the charity. And I knew the policy in my example was 200,000, so it's 100,000 each. So you could do it that way. Some would say, hey, look, I'd rather just leave a set dollar amount, and I don't want to play around with percentages, because with some of the product, and this is where Ryan once again comes in as a tremendous resource, is some products keep growing. The death benefit keeps growing over time. So if I lock in at the 50%, and in my thought, I was only going to give 100,000 my example, but the death benefit is growing, especially with a whole life policy, that 50% went from 100,000 to 200,000, depending on how long I've been around. So if I do a percentage, be careful on the type of product you have to see if the death benefit is growing, or just lock into a set value. I want to give the charity $50,000. Well, you put that down the beneficiary form, and that's it. They're limited to the 50,000.
Great. Another question. You mentioned term and whole. I think most people know the difference, but maybe you could give a quick overview of the difference between the two. And is there one better for this than another?
Yeah, no, great question. But once again, it's preference. Term policy in its simplest form is I'm paying for a policy for a term set time frame. I want a 10-year term. So I'm 70 years old. It's going to last up until I'm 80. Once that term is up, there's no more life insurance coverage. It ends. So if I don't die before then I lose the coverage if I'm not insurable next time around. A whole life policy, there are different ways it's developed. You could have a policy that you pay in, and you keep paying up until the time you pass away, or you can have limited pay products. Classic example is like a 10-year whole life, or a 15-year, or they call them LP 65s. They're paid up at age 65. The benefit there is that you're going to pay in premiums, call it a 10 pay. After 10 years of payments, you don't have to pay anymore. And therefore, it's just the cash value in a whole life policy is growing. So it's kind of like a savings account or a checking account. Money is growing inside your policy on a tax deferred basis. If the charity owns it, well, they don't pay taxes, so they don't worry. But if you were to own it personally, it's growing tax deferred. When you pull from that policy, as long as we do everything correctly, it's your own after-tax dollars, your basis in the policy. So you're pulling that out tax favorably. So if a charity were to own it, they got the tax benefits for being a charity, but now they have a sinking fund that's been growing. Term policy doesn't have that. It's just it's covering you till death for that term. Well, here I have a pool of money growing. If the charity needs it, hey, we have a bus for transporting kids. It broke down. We need to go buy a new bus or fix it. I can pull from that cash value tax favorably and pay for whatever I need. I didn't have to wait for Todd to pass away to then get that death benefit.
That's great insight. I always say it seems like term is like a lease and whole is like you purchased it, like a home
Yep.
ownership versus around.
Yep.
That's just the way I would interpret that. Before I move on, any other questions that anybody asked, just put it in the chat box or the Q&A piece. We can take care of that. Another question that came in terms of, I guess we kind of already answered this. In general, do you start with an insurance agent, CPA, or attorney? What's the best way to start for this type of process?
Ryan, did you want to go or want me
Yeah.
to go?
I mean, I would start the conversation with your financial advisor. They'll be able to navigate with your other trusted advisors. So when I do this type of planning, I'm in contact with their CPA, with their attorneys, and any other professionals that they have. The attorneys and tax advisors, they're going to give you the specifics to your situation. The financial advisor, I'm going to have the knowledge of the different products that are out there in the marketplace and be able to communicate with your trusted advisors and come up with a solution for you to find the best product to fit into your plan, working with the other trusted professionals. So that's a great question. There's no right answer. I would say getting everyone's feedback is very important. And the best planning and the best cases I have done to help people, especially with plan giving, I've worked with their other trusted advisors. It wasn't just the financial advisor and mom and dad at the kitchen table. It was, all of us on a Zoom call or us meeting together and really doing a collaborative effort to figure out the best way to go about doing this type of work.
Great, thank you. I think that's it for questions. Any closing thoughts or comments, gentlemen?
Right, Ryan, do you want to go?
Thank you everyone for your time today. I hope the information we shared will help you with your plan giving efforts. If you do have any questions or concerns and you wanted to learn more about this, you can go to my website. It's bierleyfinancial.com, and there's a link there to book a 15-minute phone call. We could just have a phone call and a cup of coffee and see if you wanted to learn more about this type of planning. Todd, thank you so much for your time today and your expertise. We really appreciate it. And Jay, thank you as always for getting this going and and all your help for the webinar today. Thank you so much.
Got any last thoughts?
Oh, no, thank you for having me. Like I said, it is a confusing area of the law. Just understand you have someone like Ryan there to help walk you through this. Ryan can always get a hold of us to ask any questions that you have, and then we help walk him through your issues. Like I said earlier, you have to have your own tax and legal advisor with you, but our job is to help Ryan out to make these confusing things a little easier. They are going to change as time develops, especially next year from the reports that we get. But just understand that you have someone here who can get a hold of us, can get the answers that you need to make this type of stuff a little more easier to digest.
Well, thank you, gentlemen, very much. Again, just a reminder, this will be on demand. You will be able to go to the Aquinas YouTube channel, which is AQ 1902. So you can watch it again, share it with others. And as always, if you have an idea, if you have a comment, if you have an idea for a future webinar, please reach out to us at the school. We're always looking for new ideas. Or if you yourself have something you think would be worth presenting, we'd love to hear from it. So thank you very much, gentlemen. Thank you for attending, and we will see you next time.
All right.
Thank you again.
Thanks,
Have a
everybody.
great day, everyone.